we start off here with the easy come, easy go market. The Nasdaq closing near the lows of the day, down 2.25% and erasing all of the gains for the month. The S&P and Dow also pulling back sharply after a strong start to April. And take a look at some of the high valuation stocks getting absolutely crushed today. Rivian dropping more than 9%. The move coming as 10-year yields spike above 2.5%, hitting their highest levels in nearly 2 years. So does today's action mark the end of the bear market rally? Tim, what do you say?
Look at this on a big desk here. This is kind of nice. By folks at home, by the way, there's three of us. And plus, of course, Melissa. Anyway, so let's get back to the question. It's a case where, first of all, 251 on the 2-year means we're at, effectively, for most people, it seems like all-time highs. No, it's not all-time highs, but again, the move higher. At semis down 4.3%. Discussed the transports, a 10% move in 5 sessions. I mean, this is, you're getting it from the most cyclical parts of the market. And I think today's catalyst really was Lael Brainard, who typically has been the most dovish member of the Fed and, in fact, is about to be appointed as the vice chair of the Fed, has suddenly gotten very nervous, is talking about, not dumping, but it felt like dumping the $9 trillion in assets on the Fed balance sheet and that they were going to do this faster than the market had expected.
Yeah, that and then also getting inflation down is paramount. So she was really being quite hawkish here in the markets, Dan.
Yeah, here's the thing, right? If we're going to start listening to Fed governors, we're going to start selling high valuation tech stocks. It brings me back to a period where the last time investors were contemplating what rate hikes, like what a tightening Fed really felt like. And if you go back to 15 and you go back to 16, and we were concerned about global growth, and I realize it's very different this time around here. I'm not liking the prospect of, if even on a day like today with crude down back to 100 or whatever, if we start to see the dollar go up, we start seeing crude go down, you start seeing stocks pick up in volatility like this, especially with the backdrop of uncertainty, Europe that's very likely to be in a recession, and then the likelihood that we're pricing in a recession in 2023, at some point stocks only down 5% are going to start to actually have to price that in a little bit. And I don't think that we've really done that appropriately. I don't think a 15% peak to trough decline in the S&P 500 from January 4th to its lows a few weeks ago adequately really kind of encapsulates all of the uncertainty we have right now.
But we talk all the time about the market isn't a monolith. There are some that have just gotten annihilated, right? And if you look at the IGV, which we look at a lot, these high flyer, all these sort of ARC kind of names just getting obliterated.
Software ETF.
Yes, the software ETF, that's sort of, it's indicative of the high flyers. So to me, I feel like that's already deep in a bear market, despite that rally that we had the last 2 weeks. So I think it should stay in the bear market because I totally agree with your point about Lael Brainard. I think that she is the most dovish. She's clearly in the hawkish camp now. Yep. And I think that the Fed does such a good job, I think, of communicating. And they're going to do it again and again. And I think we're going to hear that message about how hawkish the Fed is a few times in the next, I don't know how long, I guess minutes this week.
You sound almost sanguine about that, like the market's doing what it needs to do.
Yes, kind of. I feel like it is doing what it needs to do. And then I come back to, we're going to start to switch to earnings the end of next week. Right. We'll start to hear from the banks. I know everyone hates the banks, but I was looking at it, JP Morgan 10K. I know you hate JP Morgan, and I love Jamie Dimon, but that's beside the point. They are asset sensitive. They will make more money with rates going up, even with the curve the way it is now. Doesn't matter, though. I guess everyone hates banks. They hate them. But I'm long going in.
In that shareholder letter, though, Dimon, your favorite, did point out that a risk to the markets is that the Fed is going to move much faster. So here we are, Guy. How do you make sense of all these sort of mixed messages? Some sectors of the market are already deep into bear market territory. They felt the pain, those ARC names. Others are close to all-time highs still. And we have a sell-off in bonds and stocks.
I'd agree with Karen about the monolith thing, except that I don't know what monolith means, so that becomes problematic for me. But I'll say this in terms of the Fed. Tim says that it should be a bumper sticker. More Fed means more volatility. And for whatever reason, the last month or so, the market hasn't seemed to care. I don't think it fully understands or comprehends what's really going on here. And by definition, if by fighting the Fed, when the Fed is easing and adding liquidity, you're being bearish, that's fine. I get it. But that same definition, if you're fighting the Fed now, effectively fighting the Fed now means you're bullish. So I'm surprised at how high we've gotten in both the NASDAQ and the S&P. I still think lower. I'm in Dan Nathan's camp. I'm not trying to be apocalyptic here by any stretch, but I don't think the market fully realizes what not having a Fed backstop, what not having a Federal Reserve effectively underwriting this market, which is effectively what they've done for the last decade and a half, means.
Yeah, and I don't mean to sound so certain about this, but this seems really obvious to me. The Fed is going to overdo it right now. They're going to convince market participants that they have to be this hawkish when you have the the biggest dove saying what she did today, and they're going to do a 50 basis points. You look at that CME Fed tracker. I look at it every day here. It's pricing an 80% chance of a 50 basis point hike in May, and then maybe in June.
Yeah,
it's your show. I mean, you do you.
But okay, so
you're the Elon Musk of this show. Do whatever you want. Go ahead.
When you say, Dan, that the Fed is going to do its best to convince the markets. So you're talking about Fed funds futures, et cetera. But how about the equity markets? Has the Fed convinced the equity markets yet?
No, I mean, clearly not. And so my point is this, but this is what's obvious to me. They're going to overdo it right now, and then they're going to shift. They're going to do what they had to do in December 2018. You know why? Because we are going to see the slowdown. S&P earnings do not price that in right now for the balance of this year. And when they get dovish, when they reverse, that's probably going to be the worst time for equities, in my opinion. And again, what's different this time than 2018? $4 trillion on the Fed's balance sheet. That's what's different. Rates cannot go up meaningfully from here. If they do, the economy is going to have a problem, and the equity market's going to start discounting it right away.
Yeah, and first quarter earnings are going to be, and they've been downgraded a bit, but they're still somewhere around 5 or 6%. In the fourth quarter, they were north of 30. So the certainty is not that the Fed is going to screw this up. The certainty is that equity valuations need to be assessed differently in a higher rate environment. That's just kind of principle of investing. What we don't know is what the companies are going to tell us in terms of the strength of their business, the strength of the consumer, and I would look at revolving credit, especially as it is around auto loans, credit cards, home equity. These go up immediately. So just to be clear, I mean, these are sensitive. These are LIBOR plus. And I think we have a consumer that is very much addicted to low rates. And I don't think we've seen that. So that's what equities can't do until we get there, even though the market is a discounting mechanism.
So 2 points I want to make. The first, you had a very different administration that was just pounding on the Fed, tweeting all the time. You got to lower rates. You got to lower rates. I don't think we're in that environment anymore for the $4 trillion. That's one reason. But also, this is a different administration, and I think that this Fed will try to be less beholden to the market.
But the administration's more worried about inflation right now.
Yeah.
Think about that. So listen, it's different. My point is that if we have material slowdown, and I'll go back to you, they're going to have to get a bit more dovish because the rates have already moved in front of it. That's why we have this inverted yield curve, right? So they're not going to be able to go meaningfully higher here. But right now, in 2022, into the midterms, they're worried about inflation. At some point, as you get closer to that, I think they switch.
I mean, I think what Lael Brainerd said today in her testimony was key, and that is, if you take a look at lower to middle income households, they spend 70% of their household income on necessities, things that are more subject to inflationary pressures, Guy, and that's what's going to be squarely in Fed focus. And I hate to put these two things together, but it is a midterm election year, and we can't ignore that fact either.
No, you absolutely can. To everybody's point, absolutely not. And what's different from now and October, November, December of 2018 is nobody uttered the word inflation for basically a decade. Now it's on top of mind for everybody. Rightly so, by the way. And I'm glad that these Fed officials are so concerned about, middle America and people who are living paycheck to paycheck, because they got what they asked for. They've been begging for inflation for 10 years, and now they got it. They always thought they could control it. Clearly, that's not the case. So will they overshoot? They have to. They have no choice. The next CPI readings have a 9 handle on it. When's the last time you saw that?
I don't know about that. I mean, 7.9 was pretty high since the 80s, Tim, right?
Well, it is, and I think we've all discussed both the lag effect of, first of all, ags, whether you have the softs, the bulks, these things that are probably a 9-month delay. I don't think we've even started to see where labor price inflation goes. I think you just get back to a case where the consumer who has also been thrown money. We gave away 25% of GDP in the last couple of years. The most important in inflationary impact, and this is empirical, it's been studied, it's not the rates at zero. It's the QE. And if you look at the 4 different QE periods that we've had, and I think the unwinding of the balance sheet, which is what she talked about today, and that was what was different about this versus some other stuff, is the part that I am most worried about in terms of the impact of what it does to both the markets and the consumer. And again, remember the Fed portfolio we talked about during COVID in the early days, the stuff they were going in and buying. We were wondering why they were buying AAA Apple debt. We were wondering why they were going in and buying stuff that weren't really interest rate sensitive.
Yeah.
All right, so let me ask you this. You just talked about banks, Karen, before. What are they telling you? Like, I'm looking at the mega cap names that are keeping the S&P kind of elevated here, and the bank stocks going into their earnings next week. We know JP is going to report on the 13th and a few others. You know, it's just a few bucks over its lows. I mean, they trade horribly, and I'd like to think that investors in bank stocks, like big investors, they're doing smart things in front of events like that or periods. I'm just curious, because to me, not encouraging.
So the bank stocks, how they trade before earnings has not been a good indicator of those earnings at all. In fact, it's been a terrible, they trade well. They've been earning well for a while, They, they put aside reserves, huge reserves during the pandemic, and yet still were able to make money. Then they were able to reverse some of those reserves. And so I think 3 or 4 times they traded really well into earnings and really bad after.
But what if we're on the precipice of something? That's kind of my point here. Are they kind of like
that? To me is one of the big risks. Are we on the precipice of something? I always look at the HYG. I always look at the LQD and see. Credit is just starting to widen a little bit. This in itself, the magnitude of the move today, nothing to worry about. But if you get a couple days of it, credit, it's a psychological thing. People start to get nervous. That to me is one of the bigger risks.